What's up? Happy, I guess, the last Wednesday of June. Welcome in, More Than Mortgage, or whichever day this actually is posted on social media. But we're at the end of June. We're at the end of the second quarter. We're at the halfway point of 2024, which seems insane. I don't know why it does, because we say this every June. Can't believe the year's half over yet. Here we are. That guy's Zach Jones. I'm Chad Anderson. Thanks for hanging out with us for a minute. Zach, can you believe it? 2 quarters in, we are 1 quarter away from an election to, crown our 47th president of the United States. Obviously, a big one with all the division going on, all the economic things that are in the balances. It's kind of nuts that we're already, on the backside of. I always look at it this way: we have now crossed over to where the days are getting shorter. Already. I'm like,
and
oh,
see that,
can't believe it. The
No,
days
that's
are now
wrong.
officially getting shorter. If you ever really want to kick in the nuts to start your end of June, there it
Thanks a
is.
lot, Chad.
Yeah, I know. Tell me about it, man. Can you believe it though? I mean, halfway through the year, this is crazy.
Yeah, I mean it's we're probably coming up on well, maybe not completely halfway through the summer, but if you got school age kids, you're halfway through the summer, and
Yeah.
that's the whole thing about the election really kind of puts it in perspective for me about this year, because I my mind is kind of in that January February mode, and we're 140 days away from the election or something, and just all the things that are coming may be a little bit overwhelming. We haven't even had a presidential debate yet, and I'm not sure. I heard somewhere the other day that I guess the two front runners are not actually candidates yet.
No, they're not.
Th-
It's really just two guys who want to get in front of a camera and argue because
yeah,
they're not
yeah,
officially the candidates, right?
yeah. They're not even really official candidates yet. So what a weird year this is going to be.
Yeah,
Weird world we live
it's one of, if not the earliest debate ever, right? I mean, and
in.
by the
Yeah.
way, this show today is not about the presidential race or election, but we just start talking about the calendar year and some of the big impacts coming up for the rest of 2024. And obviously that's going to play a major role in
Right.
some of the things and what happens with the housing market and the economy and mortgage rates. So uh, Zach and I have done a few shows now on scam is such an awful word, but on things that are really frustrating to me, and I think Zach as well, that take place and are mandatory in the housing industry. One
Mhm.
of those is homeowners insurance. Another one of those is appraisals. And now today we're going to hit on a big one that everybody talks about and seems to think they know, but they don't know. And that's credit scores and reports, because
Right.
you think you know, you have no idea. And I don't mean that condescendingly. It's not your fault that you don't know. You're led down these paths that make you think you know. You're handed a score from Chase because you applied for a credit card. You log into Discover and see a score on the dashboard. You get told by Credit Karma that your score is one thing. And in reality, none of those are your FICO scores, which is what actually counts when you're trying to get a mortgage. And the reason FICO is so important is because obviously, or 99.98% of you, the mortgage payment is going to be the highest monthly payment out of all your debts that come out of your monthly budget. So, Zach, let's start there. The difference in FICO and just Credit Karma, because Credit Karma is, in our world, in the mortgage side, Credit Karma is like, we refer to them like realtors cringe when they hear Zillow. Like
Right.
that's the same thing. So tell people just the differences between the two.
These monitoring services generally are just a really poor substitute for what we're going to see in the biggest credit decision that most individuals make, unless you're a business owner. So the way I usually tell people to understand it, Chad, is that people will say, I always ask the question because I'm interested in where people land in terms of their credit history. What's your credit score? Oh, well, it's 747. Okay, well, where did you get that? Oh, I'm signed up for Credit Karma, and
Yeah.
in my mind, sometimes I'll have a discussion about it, but in my mind, I deduct 50 points off of that Credit Karma score
Same.
automatically to try to begin to price that loan out and be talking to people about loan products. So it's not always 50 points off, but the majority in my personal experience is there's about a 50-point swing between the Credit Karma score and the actual middle FICO score that we use for mortgage underwriting. I don't know. Is that in line with your experience?
No, it is. Same thing. And it almost too depends on where they say their score is. So, for example, if somebody tells me their Credit Karma score is 780, it is possible they have 780,
Right.
but I'm
It is
also
possible.
bracing for 720. And
Right.
you may say, well, 720 is still a really good score. It is a really good score, but it still doesn't get the same rate as 760 or 780. It doesn't
Right.
get the same mortgage insurance payment as 760 or 780. So there are changes. So when you're asking me to quote you a rate and then you go ask somebody else and you tell us those FICO scores, but then I quote you based on your real score, then yeah, my quote's going to look worse because it's
Right.
just different. Now, if somebody says, "Oh, Credit Karma says I'm at around 667," I go to a really dark place in my brain and
Mm-hmm.
anticipate 580. So
Right.
if you're that's all I mean is that if you're being told higher end by Credit Karma, then I believe you 720 and above. If you start saying Credit Karma said the 600s, even the mid to high sixes, I start worrying that it's going to be in the low sixes, maybe even the high fives. So it adjusts a little bit to answer your question on a scale based on where they're being told by Credit Karma.
Right, right. And it's that wide discrepancy that really drives us in the business to be in a position to pull credit. I mean, that's really
Yeah.
the thing that we want to do up front is to pull a triple merge hard pull credit score, so we do know exactly where those middle credit scores are landing.
Yeah.
Now, just so you know, behind the scenes, from a cost perspective, we don't want to pull that expensive triple merge hard pull credit report because that's an expensive report if we get bad news and you don't close the loan with us, et cetera, et cetera, et cetera. But
Yeah.
the price of that report is really, in my mind, it's worth it, as long as we're using good discretion, because we have to know where you stand. We just don't. I guess all of that's driven, Chad, by my um, desire to have this mortgage experience with no bad surprises. That's what it comes down to for me, is no bad surprises.
My
So
biggest thing too on some of that is whether you actually allow us to pull your credit or not also tells me how serious you are.
true.
Like, I mean, you can get rates anywhere if you want to just plug something in, but uh, you also aren't getting factual information. So I don't mind quoting people interest rates, but I do. I'm like you though. It makes me a little nervous because you start doing this tiptoe dance around it, being like, okay, well, here it is, and it's off of 760. And if you're even at 739, the quote's going to be different.
Right.
So you just have to understand it. And hey, we can argue about your score should be 760, even though it is 739 until the cows come home. But I can't do anything about it. And sometimes it just takes time.
Right.
So we can sit here and argue and bicker about it, but that doesn't mean you're going to get the 760.
Well, and I think that the other piece of this is that there was a statistic maybe 2 years, maybe it was 4 years ago, I don't know, that it came out that said that there was an 80% error rate in credit reporting on the average U.S. citizen's credit report.
I
Now,
didn't know that.
80% is a really high error rate. And I,
Yeah.
I called my credit repair person, the person that I make referrals to, and said, hey, I mean, is this real or is it clickbait? Is it drama? And she said that it was in fact true by their experience, but that doesn't mean that there was an 80% rate of error that resulted in a deterioration of credit scores. It just meant that, dates could be wrong, the type of account could be wrong. All of those can positively or negatively affect, but that there was an 80% rate of inaccuracy on credit reports. So then she went on to say that the number was at least 20% of credit reports had things on them that pulled the score down incorrectly and falsely. So even that's worth it, and I've had so much experience pulling credit reports where people say, "Hey, listen, I've got an 800 credit score, a perfect credit. I've never missed a payment in my life." And then we pull it and I say, "Oh, wow, listen, there's bad news here. We've got, a missed car payment 3 months ago." And then somebody's in trouble. Now, the eyes dart across the table and say, "Well, what happened?" "Oh, I forgot to tell you about that. The dog ate our car payment, and I did miss making that payment." So, there's always that piece of it. But Chad, I usually explain to people this difference between Credit Karma or what you see in an Equifax score on your Chase card or whatever it is. You see these numbers come through on your monthly bills.
Yep.
What I usually tell people is that there's a different scoring mechanism because this is a much more serious financial risk to a lender. So if you go to Old Navy and you're trying to save 15% at the register on their back to school sale, they're going to score your credit history differently for a $500 line of credit at the Old Navy register than the mortgage industry is going to score you for a $500,000 mortgage loan. It's just a more serious, stringent scoring criteria. They're going to grade you differently. It's a grade. Listen, let's talk about credit scores. Credit scores are a grade. You either get an A+ or an A or a B or a B- or a D+ or whatever it is.
So this is one thing I want to transition talking about the scores and a little bit of the model. This is one thing that drives me nuts a little bit with credit. And if I'm wrong on this, feel free to correct me, or if you find other things that annoy you or that you see that could lead to inaccuracies. Credit reports or your score is based on timeliness, making payments on time, kind of a fundamental. It's also based on how long you've had accounts open. And here we go with the balloons. It's also based on how long the accounts have been open. And then another thing that it's based off of is what the balance is based on your credit limit. And that's the biggest one I have the problem with, because a lot of times, depending on when it's reported, your usage could be inaccurate. For example, if you get paid on the 15th of the month, but the bill is due on the 17th, well, you use the 15th to pay the bill. I'm sorry, let me back up. Bad example. 15th and 15th. Let's say you get paid on the 15th and the bill comes out on the 15th. Well, by the time you get paid on the 15th and then you try to go pay the credit card on the 15th, a lot of time the money hasn't settled. Like, it doesn't post or show exactly. So when your bill for the credit card comes out on the 15th, then let's say you've got a $3,000 credit card limit. Well, if you ran up $2,200 that month, then that's what shows on your credit report. They will go and report because that's what's going to appear on the statement. So they say, "Oh, that statement had $2,200 on it." But in reality, you pay the bill every single month to $0 or $50 or $100. You're responsible. You run it up, you pay it off. You run it up, you pay it off. But it's almost as if, based on the timing of the reporting, it could appear that you carry high balances, and high balances hurt your credit score.
It's so the timing of that snapshot.
Yeah. So that's just another little thing to watch with credit that people sometimes miss. They're like, "I pay it off every month." It's like, that may be true. But if the bill comes out at the time that the balance is extremely high compared to the limit, then that can impact you. Have you seen that before? Are there any other like little hidden tricks or anything that you know
Well, I
of?
think, yeah, I think it's really hard to time that, Chad, because the credit bureaus aren't reporting in real time. And so, if you were really trying to prep yourself for, having the very best and highest score when you want to do a mortgage application, then you almost have to go 30 days out and just not pay your credit down, and then not use your cards at all, so that you get a fresh look, and you've gone through that, whatever that refresh time threshold is with the credit bureaus, and when your Chase card actually reports balances. The other thing that I ran into recently with a personal friend of mine who is applying for a mortgage was the situation where a business agrees to reimburse an employee for their business expenses that they charge on a card, but they require that employee to get their own American Express card or something that's linked to the business, but it reports on their personal credit report. Instead of issuing a company card, it's a personal card. So you might catch somebody with a $7,800 limit because they traveled last month on an $8,000 card, and they get hammered. And, then you got to go through the American Express problem of explaining that it gets reimbursed by the company. Is there a history, and how can you prove that? And what's the minimum payment on an Amex card?
Well, those are just some of the things you really do have to watch for, because it's, again, not everybody understands the models and the little things that could trip you up. I want to hit 3 other things real quick during this show, podcast, whatever you want to call it. One, I send people to myfico.com. If they ever have questions, myfico.com really spells it out. Like, if you're that nervous about credit, go read it over there. I actually subscribe to that because they do a lot of great things. They monitor the dark web. They give you a score every month. They kind of keep you up to date on everything. So I end up, using them quite a bit, and I trust them, and they have a lot of good information, and they really spell it out in layman's terms. That's who you use, or do you ever refer anywhere else?
It's the only website that I trust to give accurate information about credit scores, period.
Okay. That's pretty strong there, Zach. I guess we'll move on from that one.
It's been that way ever since they started. They were the only real resource for anything credit related as far as scores are concerned.
Got it. All right, cool. The next thing, let's talk about trigger leads for a second. The bane of our existence, right? Here's what happens. And this is another thing it's just a complete scam. Like, the trigger leads to me are the poster child for scams and just unethical practices. And the reason I say that is because
Define what's a trigger lead.
Yeah, thank you. All right, so trigger lead, here's what happens. Zach pulls your credit because you want to buy a house, and the only way you can buy a house is you have to get a mortgage unless you have cash. So when you go and get the mortgage from Zach, or attempt to, and get pre-qualified and pre-approved, and Zach says, yes, sissy, you can go over here and buy this house. I use sissy because that's our inside joke. So you can go over here and buy this house. And when you do that, we have to pull credit. So Zach pulls your credit, and he tells the agent, hey, John and Jane are fantastic. Good to go. Your data gets sold by the credit bureaus to these companies who have an interest in trying to sell you something. And so they sell your data. Now, they don't sell like crazy stuff. From what I understand, it's basically name and phone number and maybe some date of birth stuff, or an address for a mailer. Like, your social isn't going out there, is my point.
I think they also will do what? Well, no, never mind. Past that.
So your data gets sent out there. As soon as somebody pulls your credit, somebody else will call you in less than 5 minutes to try to sell you something. If Zach pulls your credit, Rocket Mortgage is going to call you in less than 5 minutes, and they're going to beg for your business. They're going to tell you whatever you want to hear. They're going to sit in a cubicle somewhere else and they're going to do anything and everything possible to get you to listen to them. And it's not just them. You're going to get probably 20, 40, 60 phone calls. And here's the beef is that you can't avoid it. Zach and I can't avoid it for you. There's one thing you can do, and that is you could go to a website. It's called optoutprescreen.com. Now, Zach and I have tried to help customers in the past by saying, hey, go to this website, or with your permission, I'll go there for you and put in your info to try to prevent any of this kind of stuff. But a lot of it just doesn't simply work. Or you need an approval, and by the time we enter in your info, it doesn't set long enough or go through the channels of getting you out of other people's systems or preventing them from getting it. So they still get it, even though we tried to be proactive on the front end. So you really just need to go to that website now, even if you're not going for a mortgage, and just put your info in there and opt out of everything. And it's supposed to prevent it. There's actually a bill in Congress that's pretty far down the priority list of trying to eliminate trigger leads. But that's what's happening is all of a sudden 60 mortgage companies will start calling you, trying to get you to use them. And once they get going, it'll be some of the biggest bait and switch, unethical, relentless call center tactics that you've really ever seen in your life. People call me all the time, frustrated with me because they're getting phone calls, but there's nothing any of us can do about it. I'm sure I know you have plenty of war stories on this.
Well, this is such an important issue to me because it's such an intrusive thing that the credit bureaus do that it's one of the things that I always talk with clients about on the very first phone call. And then it's also when I send my application email out, I've got a paragraph dedicated to optoutprescreen.com. And I've got then I've got a couple of lines that say, go apply here. So the emphasis and importance is on opt-out pre-screen. Like you said, I have had really great success with this website and it processing on time, but it doesn't work 100% of the time instantaneously. I hear people say different things. Oh, it takes a day to work. It takes a week to work. I haven't ever had a situation where it took a week to work, but it seems like more recently, like I was on a roll and I just didn't have any people calling me and saying, oh, I'm getting 75 calls a day. And it's maybe happened 2 or 3 times since then. And so I'm kind of in my mind, I'm thinking, well, maybe they're doing maintenance on the system. It's just unlucky. But if there's like one message in this whole podcast that I would broadcast to every citizen, Social Security bearing citizen in the United States of America, it is go to optoutprescreen.com and opt out of the credit bureau selling your data for as long as you possibly can. The last time I looked at it was when I personally did my own several years ago, and you could opt out for your lifetime at that point. I don't know if they have the lifetime opt out, but I always tell people, listen, I don't want anybody calling me about on my phone and soliciting me and giving me special offers and doing all that stuff. I just don't want it. If I'm shopping for, car financing or house financing or even a credit card, I figured out what I want by the time I make application. I know what I want. I don't need a call center in Bangladesh to be calling me and offering me something special.
Oh, yeah, you do, Zach. Yeah, you do. No, it does drive me nuts. And it just opens the door for true scams. And people just being dishonest. I mean, that's really what it does. So that's trigger leads. They suck. We all hate them. But as of right now, there's nothing we can do about them. So, and here's the other problem too, that really frustrates me is that the cost of the credit report keeps going up. Like it used to be 25, 30 bucks. Then it went to 35, then it went to 45, then 50, then 65. Now it's up to some, depending on who you use and where you're going through, whatever. There's some that it's $94 now.
Right.
$94 to pull your credit. And then when you say, well, what about the rapid rescore? you can do it super expensive. So when a lender is like, yeah, I mean, we can do it, but it's costly, just don't be shocked when they kind of throw that out there. Like, there is no free lunch is the best way to say it. It just doesn't exist. It's a very, I don't know. It's just one of those, it's like there's multiple steps and so forth, but it does cost quite a bit.
Well, my perspective on that credit score cost too, Chad, this is my cynicism showing, but I think I'm right about it, is that the bureaus know that they're in trouble with these trigger leads, and that's a source of revenue for them. They make money because they
Yeah,
sell
sure.
your information. And so because of the teeth that are in this bill going through Congress, even though it's a low priority, that will ultimately end. And I believe the credit bureaus are doubling and tripling their pulls, their credit pulls, the cost of those, because they know that trigger lead revenue stream is going to be diminishing over time. So
Yep.
once it finally does, our credit report's going to cost us $200 or $250 or $300. I mean, that's unbelievable, Chad, but it's believable.
Well, the other problem is the cost to just do a mortgage is getting higher and higher and higher.
Always
And
high
so,
regulation.
yeah,
Regulation
and
costs
so
money.
that's just going to make it even harder, especially in a higher rate environment, from what we're used to, and a lower volume. It's
Right.
just difficult right now. A lot
Yeah.
of people don't realize these different costs. What do you think? Two more things. What do you think about credit repair companies? I know you did a reel on one the other day. I think it was a success story, though. It was a good thing. I'm torn. I think there are good ones and bad ones. I've caught someone trying to sell me on, oh, you need to use me because of this, this, and this, and it wasn't true.
Right.
And we were able to get the score higher, but they were looking for the sale. I've had another person try to take advantage of a situation. I've had credit repair companies say, oh, well, we're just going to go dispute these 8 trade lines. Disputes in the mortgage world are the worst thing you could do, just about.
Right.
Which is bad. But I've had one or two that were sincere and actually made an impact. So curious on your thoughts there.
The old model, I absolutely hated and never made a referral to credit repair because I didn't trust them. And the old model was a subscription service where they put you on, $299 or $399 a month, and then they work on it. Well, what never made sense to me about that, people who are applying for a mortgage that need credit repair, they need to go fast. This is an important thing that is time sensitive. So the folks who are on the subscription plans, they don't have any monetary incentive to go fast, because if they cure your credit in 90 days, then they miss out on the big bucks. So,
Yep.
they're more inclined to slow walk you and make excuses and, forget to do this and forget to do that so that they can get more and more months. And I don't know what the average participation rate is. If they can average sign you up for 18 months, that's awesome at $400 a month. That's amazing. But the model that came along that I became aware of several years ago is a model that kind of flips the script on that. And that is, the company goes in there to do credit repair, and they don't get paid until the item is deleted from your credit report. And I'm talking specifically about collections and adverse reporting circumstances. So I've had situations, Chad, where the amount that the company that I use, so let's say somebody had a $1,000 medical collection, and this company that I use would go in there and negotiate for a $500 settlement. But as a part of that settlement, they would also negotiate for a full deletion from the existence of that account on the credit report. So it vaporizes. The credit scores instantly rebound because there's now no negative credit reporting around that previously negative credit event.
Mm-hmm.
And the price that they charge for this, because they're so good at it, is really, the last time that I priced it, it was $70 per item per bureau. So if you had a collection reporting on all 3 bureaus, you could pay $210 to get that removed from all 3 bureaus. Everything else has gone up. Let's call it $300. If it's $100 per line, then think about this. You had a $1,000 medical collection. They settled it for $500, charged you $300, and the whole thing vaporized. So you paid $800 to make a negative $1,000 credit event disappear.
Yeah.
It's such an awesome model, and they're motivated by the calendar because they don't get paid unless they prove that those items are deleted completely. So
That's
they've
awesome.
just gotten really good at it over the years, and I think that's why they can do it so cheaply.
Yeah, that's a good one. And that is completely different from some of the past experiences that I had, which was, oh, pay and work with me 12 months and we'll get back with you.
Right.
That one, those suck, just to be honest. All right, last thing. This is something I don't think enough people know about. If you're young and you don't have credit and you're trying to build credit, everybody always says like, oh, go get the secured credit card, go to your credit union, open up a little account, whatever, have them report to your credit, all those things. All that stuff's good, right? But then the next thing that people don't realize, and I see it more and more and more, you can get your utilities reported to your credit bureau. So anyone who needs credit, or you have a son or a daughter, or a first-time home buyer, or somebody struggling to build credit accounts, you can call your local utility company. And this is electric, gas, water, a lot of these different ones. And you should check with a lot of your creditors and just say, hey, I'm paying you every single month for my apartment utilities, whatever the case may be. Can you please put this on my credit report so that it'll reflect as on-time payments so that I can build credit? And they'll do it. And people think we're crazy, but before we would have to get those items for non-traditional credit to build a case for you if you didn't have a credit score for an FHA loan or a USDA loan. Now you can actually just have those things reported to credit and you get a score. So have you seen that a lot? I've seen it a whole lot more in the last 2 years than I used to.
Yeah, and that information is getting out because I'll pull a credit report and it'll have utility or telephone self-report, several items on there. And it looks to me like maybe there are some parents who are getting 2 or 3, utilities reporting on their credit report because that maybe they signed up for it for a minor child who's in college, or, the cell phone plan or whatever it is. So I do see that a lot. And what's the other great thing about that, Chad, is that we don't have to count that as a debt on the credit report. So you get full benefit of that payment history and building a credit history and on-time payments. Make sure you make the payments on time. That's the other piece of this. It seems obvious, but maybe not so obvious, right? But we don't have to count those bills against you on a monthly basis because they're utilities. The other thing that I would add in here as a part of this plan, multi-pronged plan, one being secure credit cards, the other being utilities. The third one could be getting signed on as an authorized user on a family member's credit card that has a perfect payment history. Now, you don't want to overdo that or do that to the exclusivity of these other things, because if a mortgage underwriter sees that all you've got is authorized user accounts, you're not going to get very far with a mortgage. But if you do that in addition to these other things, man, you can create an awesome credit score in a relatively short period of time.
Yeah, no, that's it. And that's the key. I actually have someone just like that right now who only had an authorized user account of mom from 25 years. Credit was 800. Got his own card, opened it up after 3 months, started reporting. His score dropped. People go, well, why'd the score drop? Well, the score dropped because the only thing he had was a 25-year authorized user account. This is more indicative of what his true score is. But 3 on-time payments, and he's still over 740. Yeah. And he's also working to get the utilities reported. So when those start reporting, now you've got a card and 3 utility trade lines. So you got 4 trade lines there plus mom's authorized user. So the authorized user is going to stay somewhat hidden because it's one of 5 accounts rather than being the only account.
Right.
So
exactly.
huge difference.
It's diversification, just like your stock portfolio would be, is you got multiple different things that are reporting.
Yeah, 100%. So final thought on credit?
A necessary evil. Take care of it. Play the game. You know, there's a lot of people out there. I do have a final thought. Let me say this. Dave Ramsey says you don't need it. And I say he's wrong about that because the world revolves around these scores. So I would agree with Dave Ramsey if you want to go down the road and say, well, you shouldn't be paying interest rates on revolving credit cards. That's a great idea, but you don't have to. I have a number of clients. Well, I've seen them on both sides of the fence. Dave Ramsey, you know, we don't have any credit. We haven't borrowed anything. We do everything in cash, and you got 0 score. So you're going to pay. We might be able to get you qualified if you got, you know, an alternate credit history with, you know, utilities and that sort of thing, but you're going to pay 1% more, period. There's not a way around that in your interest rate. So get in there and play the game. You don't have to carry a bunch of debt and pay a bunch of interest if that's not your bag, but you do need to get in there and play the game, charge it up, pay it down, charge it up, pay it down, charge it up, pay it down. And as long as you're operating in the grace period, you don't ever pay a penny to the bank and you can sleep at night.
You know, I simply use credit mainly to help my travel lifestyle. That's really it. Like I use cards and it's really just to accumulate points and statuses with you know, airlines or hotel groups or something. And that's it. And do I pay a little bit of interest? Like, yeah, but that's because I'm paying it down to $100. I don't pay it completely to 0.
Right.
You know, I pay it to 100 or to 50, or maybe, you know, on a slow month, we only pay it to 300 or 400 and then, you know, catch it up the next month or something. But we're playing the game. We're just doing the same thing everybody else does, is we're just playing the game. And I'm with you on Ramsey. And that's, you know, hey, look, I don't agree with him on the 15-year stuff. I don't always agree with him on the car loan stuff. I definitely don't agree with him on waiting to buy, although he says you should buy now. And I'm completely against him on the whole credit thing, because like you said, if you have no credit score, I could still do a loan for you, but I now have to charge you a higher interest rate just because you didn't have a $500 credit limit somewhere. Look,
your insurance is going to be higher. All of the
everything.
things that are operating behind the scenes on credit scores going to be higher.
The thing with Dave is, and I understand what he's doing, and he can't really veer from this at this point because it would confuse everyone. He's preaching very, very conservative common sense to the masses. That's all he's doing, because the large part of his audience, they can't help themselves, or they've gone so far down a bad rabbit hole that he has to take or preach extreme measures to get them out of that rabbit hole.
Right.
But
right.
if you're a disciplined person who can understand and play the game, and you have a level head and you don't get too far, we all get the, oh, I really want that right now vibe. But if you can avoid that, or only let it impact you once a year or something, then it's okay. Have credit, open a credit card, use 0% to your advantage, use miles and rewards to your advantage. Just don't get trapped where you have a $20,000 credit balance. That's when it starts to get bad. So, all right.
Perfect.
Good topic. Went longer than normal, but good show, good topic. I love the credit one. Go back and watch some of the others as well. We talk about insurance, we talk about appraisals, and we've got 31 other episodes on there for you to just bore yourself and fall asleep to every single night for a month. Follow us on all the socials here: YouTube, Instagram, Facebook, at Zach Jones Loans, at This Chad Is Real. That guy over there does a good job with all the reels and stuff too. So make sure you're paying attention to those on his platforms. Appreciate everybody hanging out, and we'll be back next week getting ready for the old 4th of July, America's birthday, coming up soon. So we'll be back next week. Have a great one. Take care.
Thanks for joining us.